Think about the last time you checked your bank account before bed. You open the app. Your balance appears on the screen, $3,847, or $12,203, or whatever number you've been watching tick up and down with each paycheck and bill. There it is, solid, safe, waiting. You lock your phone and go to sleep. That number feels like a fact. Like your money is sitting there in some digital vault with your name on it, resting until you need it. The bank even calls it a savings account or a checking account, your account. It reinforces the feeling that this money is simply stored, protected, doing nothing but waiting for your next swipe or transfer. But here's the thing most people never stop to consider. What is that money actually doing right now, not what the bank tells you it's doing? Not the reassuring language in the fine print about FDIC insurance and secure infrastructure. What is it doing, right this second, while you sleep, while you work, while you go about your life assuming it's just sitting there? The answer isn't what you think. Here's what's actually happening the moment your paycheck hits your account. Your bank doesn't store your money. It deploys it. That $3,847 you saw on your screen? The bank just turned it into inventory. Within hours, most of it is out the door, repackaged into mortgages, auto loans, credit cards, and business lines of credit. Your money is being lent to someone else at interest rates between 4 and 20% or more, depending on the product. Meanwhile, the bank pays you a fraction of a percent on your balance. In many cases, 0.01% on checking accounts. Maybe 0.5% if you're in a standard savings account at a big national bank. Let me be clear about something. This isn't a side operation. This is the business model. It's called fractional reserve banking, and it works like this. For every $100 you deposit, the bank is allowed to lend out $90 or more while keeping only a small reserve on hand. They're not asking your permission. They're not splitting the profit. You get a symbolic interest payment that doesn't come close to covering inflation, while the bank generates profit from the spread, the difference between what they pay you and what they charge borrowers. This is the system's quietest wealth transfer. You provide the liquidity. They multiply it, lend it, and collect the returns. And you're told this arrangement is what safety looks like. So let's talk about how that profit actually gets made. Banks operate on something called net interest margin. That's the gap between what they earn lending your money out and what they pay you to keep it deposited. The wider that gap, the more profit they extract. Here's a concrete example. Let's say you keep $10,000 in a savings account. Your bank pays you 0.46% annual interest, the national average for traditional savings accounts at large institutions. That's $46 a year. $46 for letting the bank hold and use $10,000 of your dollars. Now here's the other side. That same $10,000 doesn't stay in your account. The bank immediately folds it into their lending operations. A portion might go toward a personal loan at 11% interest. Another chunk might back a credit card balance at 18%. Some of it might fund a mortgage at 7%. Let's stay conservative and say the bank lends your $10,000 out at an average rate of 11%. That generates $1,100 in interest income for the bank. Every year, from your money, you earned $46. They earned $1,100. The difference, $1,054, is profit the bank made using your liquidity, your deposits, your decision to trust them with your money. And this isn't happening with just your account. This is happening across millions of accounts, every single day. The aggregate profit runs into billions annually for large banks. Meanwhile, your $46 in interest doesn't even keep pace with inflation. Your purchasing power is actively eroding while the bank compounds returns on the same dollar you think is sitting idle. Now let's go deeper into how your deposit gets multiplied, and why you never see that upside. Fractional reserve banking is the mechanism that allows banks to lend out most of what you deposit while keeping only a fraction in reserve. The reserve requirement used to be around 10% for many institutions, though regulations have shifted. But the principle remains. Your deposit becomes the foundation for far more lending than the original amount you put in. Here's how it works in practice. You deposit $1,000 into your checking account. The bank holds $100 in reserve and lends out $900 to someone else. Let's call them Customer B. Customer B uses that $900 to pay a contractor, who then deposits that $900 into their own bank. That second bank now holds $90 in reserve and lends out $810 to another borrower. That $810 gets spent and deposited again. Another bank lends out $729. And on it goes. By the time this cycle completes, your original $1,000 deposit has generated nearly $10,000 in total lending capacity across the banking system. 10 times the initial amount. That's the multiplier effect, but here's the twist. You still only have access to your original $1,000. You still only earn interest on that $1,000. The bank, and the broader system, just created $9,000 in additional lending power using your money as the foundation, and you see none of the compounding returns from that expansion. You provided the liquidity that made the multiplication possible. The banks captured the profit. And you're told this is how a stable financial system operates. You now see how the system works. But here's what most people still don't realize. Why banks push so hard to keep your balance high. Banks don't just want your money. They want a lot of it, sitting still, for as long as possible. That's why you see minimum balance requirements to avoid monthly fees. That's why they offer tiered relationship perks, free checks, waived ATM fees, slightly better interest rates. If you maintain $10,000, $25,000, or even $50,000 across your accounts. The messaging is subtle but constant. Keep your money here, keep it accessible, keep it liquid. They frame it as convenience, as security, as smart money management. But every dollar sitting in your checking or savings account is a dollar the bank is actively using to generate profit at your expense. Consider someone keeping $25,000 in a high-yield savings account at 4.5% interest. That's one of the better retail rates available right now. Sounds responsible, right? That account earns $1,125 per year. But the bank isn't holding that $25,000 idle. They're lending it out, folded into mortgage pools at 7.5%, auto loans at 8%, personal loans higher still. Let's stay conservative. The bank earns 7.5% on that $25,000. That's $1,875 in annual interest income. The spread, $750 per year, is pure profit. Per customer. Multiply that across millions of accounts. Now zoom out further. Historically, a diversified portfolio, stocks and bonds, returns somewhere between 8% and 10% annually over the long term. If that same $25,000 were invested instead of parked, it could generate $2,000 to $2,500 per year, compounding over time. The difference between $1,125 and $2,500 isn't trivial. That's $1,375 per year in opportunity cost. Over a decade, that gap becomes tens of thousands of dollars in unrealized growth. You're not just earning less. You're sacrificing real wealth building so the bank can profit from your liquidity. So here's exactly what you do. Step 1. Keep only 1 to 3 months of expenses in your checking account. That's enough for bills, daily spending, and a small buffer. Anything beyond that is working for the bank, not for you. Step 2. Move your true emergency fund, 3 to 6 months of expenses, into a high-yield savings account at an online bank or credit union offering 4% to 5%. Not 0.5%. Not the account your checking is tied to. Shop for the rate. That's your money. Make it work harder. Step 3. If you're holding more than 6 months of expenses in liquid cash, calculate what that's costing you every year. Take your total balance, multiply by the difference between what you're earning and what you could earn in a low-risk alternative, treasury bills, money market funds, short-term bond ETFs. That number is what you're giving up annually. Decide if that cost is worth the convenience. Step 4. If your bank requires a high balance for relationship perks, run the actual math. Fee waivers and free checks rarely exceed the interest spread you're losing. Most of the time, you're paying for perks with opportunity cost. Reframe how you see your bank. It's not a passive vault. It's a profit-seeking business that uses your deposits as inventory. You get to decide where your money works hardest, and who benefits from that work. If this breakdown was useful, you'll want to see how to actually build a cash allocation system that prioritizes your wealth, not the institutions. And if you want more of these breakdowns, the kind that show you what the system doesn't say out loud, subscribe. Because this is just the beginning.